Hello, in this video we are going to discuss a very powerful alternative to active stock picking. So when we don't have time or the knowledge for active stock picking, we can leverage ETFs for our stock market exposure. This is what Warren Buffett has to say about it. By periodically investing in index fund, for example, the know nothing investor can actually outperform most investment professionals. So let's get started. Exchange traded funds, this is same as mutual funds, but the differentiator is that they are traded on stock market. uh, so they can be active or passive. Active are the funds which are actively managed by a fund manager, and thereby they are little expensive, their expense ratio is little more. Passive funds are based on a market, and they can be completely managed by some computer algorithm. So there is no active fund management team required, thereby passive funds are little cheap. Trailing 12 months percentage change, so if there is any rate or interest rate difference between the last 2 months, that is called a TTM, percentage change. CAGR is compounded annual growth rate. It is the growth which we expect over a specified time period. And we assume that the interest has been compounded over a constant rate over that time frame. So let's see with an example. So if we invest $100 with a 10% CAGR, then after 10 years, it will become $259.37. So after 10 years, the original $100 becomes 259.37, which is equal to a growth of 159%. So 110 and 259, if you compare, it is a growth of 159%. And the CAGR, if we consider, every year we are getting 10% interest. So after the first year we get 110, after the second year it becomes 121, and after 10th year it becomes 259.37. That's what CAGR, and that's what is the power of compounding. So these are the funds which I want to recommend you. This icon indicates that these three are passively managed funds, which means the fund manager does not manage the fund, thereby the expense ratio is less. This one is managed by an active fund manager. So in the category of index fund which tracks the S&P 500, I would choose VOO. For the value ETFs, which are the investment funds designed to provide exposure to stocks that are considered undervalued by market. So for that one, it is SPY-V. For the growth ETFs, which provide exposure to stocks or assets that are expected to have above average capital appreciation or growth potential, for that, I recommend QQQM. And for the dividend, so if in case we are expecting that we want to get a dividend, which means money every quarter or every year, I want to get some money out of my ETF, then the fund which gives generous dividend, in that category, I would be choosing SCHD. Now let's see these funds. So let's see the first fund which we discussed, ETF. So that is VOO. So VOO, if we see here, it is giving you a total CAGR of 8.27%. And for the trailing 12 months, for 3 years it is 10.72, and for the 5 years it is 11.15%. This is also categorized with respect to dividends and with respect to the CAGR in terms of price change, but we can just consider this metric, which is the middle one out of these three. Now let's go to the other fund. The other one is SPY-V, which was meant for the value funds. And for this, if we see trailing 12 months, 10.93, 3 year is 14.15, and 5 year is 9.47. Let's see the third one, which is the QQQM, and which was in the growth category. And we can see that trailing 12 months is 17.42, 3 years is 9.48, 5 years, because this fund has not lasted for 5 years, it has just started. So 5 year is not indicated here. Now let's see the last one, which is for the dividend category. Trailing 12 months, we have got 0.65%. And if we see the last 3 years CAGR, it is 13.26%. and the last 5 year CAGR is 10.86%. Thank you very much.